While it's raining outside, I thought I would post the fourth and final lecture about futures contracts. So when we finish this, we can go back to some of the more rigorous modeling we were doing in this class. So let's move along here and finish this off by talking about futures hedging. Now we've lowered our expectations a little bit on this topic. We've gone back to the Bentley-Bentayga, although we are selecting the Bentley-Bentayga Speed, which is about $60,000 more than the Bentley-Bentayga V8. This car, I think, sells for about $270,000. However, if you're not interested in this car because it's a gas hog, and it really is, but you only drive these things about 1,000 miles a year if you own them, then you might be interested in a vanilla bike made in Portland, Oregon, hard to get and almost as expensive as a Bentley-Bentayga Speed. We're going to try to buy at least one of these from the profits we make on hedging, although hedging really isn't to make profits so much as it is to protect profits. Before we get into that, though, we need to go back to our spread discussion because we're still live playing the QME Mini Crude contract, which you may remember is half the size of the traditional CL contract for crude oil, West Texas Intermediate, on the Chicago Board of Options Exchange. The last I talked to you in this class, not the last I talked to people on YouTube, we were long in the May contract and down about $3,500, if I recall. That turned around and I sold that for a small profit of only $100 because I figured out that I had probably paid too much for the contract. I should have let it come down in price a little more. So I was in overpriced. I was lucky, I think, to get out of that with only a $100 gain. It popped up on Friday, and that's when I was able to sell it. But we want to do spreads anyway, and we're currently in a spread, and we're going to talk about that. Let's remind ourselves of this contract. This, by the way, the slides were taken today at around 12:30 p.m., Tuesday, April 7th. It's a day in which the markets almost fell, or didn't fall, were perfectly flat. You can see the SPX and the Dow over there on the right side at the bottom, almost perfectly flat for the day. So this was a day that was kind of quiet compared to yesterday's big 1,600 point Dow rally. Now when we look at the NYMEX Mini Light Sweet Crude, we remember that the contract is for half the number of barrels that the main contract is for. So this is still a big contract at 500 barrels. So at the price of $25 per barrel, this contract has a notional value of $12,500. And because I'm using Interactive Brokers and I'm a small trader compared to the people who normally trade these, if you look there at the gray sheet in the middle at the bottom, the current margin requirements, 4,428 for the initial, but more importantly, the overnight margins are 4,428, and since we're in these contracts occasionally overnight, then the margin that counts for us is that $4,428 margin. That's a lot for this, but that's because of the volatility. So the margin on this is 35%. If you're a small trader, and that gives us a multiplier of only 2.82 to 1, but even so, that's a rather substantial multiplier in this crazy market, because a penny move or a penny change in spread is $5 affecting your contract and settlement. So a dollar move or a dollar change in spread is $500 gain or loss. Now, when I say change in spread, we'll talk about that in just a minute. We're now in spreads. Those are a little bit safer to play. They're non-directional bets like the bet that I was in. You're simply betting that the spread on this contract is going to narrow if you take the spread trade that I did. So let's take a look at that. We note here that the contract is still in contango. I'm showing the big contract here, but the small contract is pretty much the same price. You can see again, we're looking at the May, June, July, and August, September up there at the top. And if you take a look at the spreadsheet I have there in the center on the left, that's today. And the last one I showed you was on March 31st. That's the one on the right. I have that there for comparison. So the first time you ever heard about this, the spread between the May and June contract was 393. But today the spread between the May and June contract was actually 482 at one point. And just as I came down here to record this, the spread was 1 dime under $5, so it was 490. So as you can see down there near the bottom, we sold the June contract for $30.72, and we bought the May contract for $26.40. We only have one of each, but this is a pretty volatile contract. I'm trying to pick up a second spread at a $5 spread. I've been trying to do that all afternoon, and like I say, it's been a dime under. So the spread we got was 37 at the very, very bottom. I'm referring to this now. The spread is equal to 37.25 minus 26, or 432.5. So the spread was actually less. I bought the spread earlier in the day than when I did these comparisons here on the Excel spreadsheets. The max profit we can make on this is about $2,000, and that's if the spread completely collapses. But realistically, the maximum you can make on this is about $1,250. So you can kind of easily lose or win or gain. It's not a win, I guess. $600 or $700 on these spread contracts. And again, our position, since we went short on the upper contract and long on the lower contract, we went short on the June, and we went long on the May, which you can see down there in that contract. Then we want this spread to narrow. And the spread all last week was $2.50. So if the spread narrows by $2.50, we can take that $2.50 and multiply it times 500. So we'll make a little over $1,000 if that history repeats itself on that. And I'm pretty confident that we'll make some money on this. I'm not going to try to hold out for max. So we're in that contract right now, and we're still pursuing the strategy that I talked about last time in video 3. Now let's get into hedging. Two contracts that are used extensively for hedging are two contracts we're already aware of, and that's the CME Group S&P 500 E-mini and the Micro E-mini contract. And we were just looking at a trade that we had made for the oil in that contract. And so remember, SPX itself is 250 times the S&P 500, so it has a staggering notional value of almost $500,000. But the ES contract, which is the traditional E-mini that's on the left there, is 50 times. And the Micro E-mini contract, which is something that even you can trade in if you have no money or very little money to get used to this, is 5 times. The symbol of the E-mini is ES. The symbol for the tiny one is MES. The notional value at today's prices, say at $26.60 for the E-mini, is $133,000. It has a maintenance margin on CBOE for professional traders of $12,000, but the overnight initial margin on Interactive Brokers, which is what would apply to us, is $23,275. So you would need to have at least $40,000 or $50,000 in your account to play this middle-sized contract, the ES contract, because you don't want to obviously tie up all your cash with initial margin. These contracts trade in March, June, September, December. A 1-point move in the index causes a $50 change in settlement. Now the little one, which we can play, you can play, it has a notional value 1/10 of the mini, so the Micro E-mini has a notional value, in this case, $13,000. The maintenance margin is also 1/10 on CBOE, and the overnight initial margin on Interactive Brokers for non-professional traders right now is $2,327. So that's not a problem. We can play 5 or 6 of those if we want. And the point move, of course, is only $5. Now these all move together because arbitrage is going to make sure of that. So you need to remember that specs on the SPX provide the correlation coefficient, And the denominator for the beta formula that we've been using on and off in this class, the beta formula that you learned in Econ 104, which recall was, if you're comparing it to a portfolio, for example, the ratio of the standard deviation of the portfolio divided by the ratio of XPX times the correlation coefficient between the portfolio and XPX. We'll come across that formula in just a minute. And we also remember that options on the large contract provide the basis for calculating the VIX. And the VIX has been drifting down since its peak about 2 weeks ago. Today it was around 45. That's still very, very high, because before this catastrophe happened, we were looking at the VIX of around 15 or so, 16 or so, would have been considered high then. So it's high, but certainly not the 65 or so it was just a few weeks ago. Now, these index funds we're talking about, including not just the S&P, but the Dow and the Russell and the like, are really good for hedging stock positions. And let's remind ourselves of why. Index funds are great leveraged directional bets, because if you just want to bet on the market, I think the best thing you can possibly do is, instead of even paying, well, you can bet with SPY, obviously, if you want to, but it's just as easy to bet with MES if you have an honest-to-God brokerage account, because, again, it's a contract that requires a margin of just a little more than $2,327. And that's going to be less than what it costs to buy 100 shares of SPX. And you can't easily go short at SPX. And you don't want to make, you don't want to use options always to make directional bets, because you have the time decay problem if you're long or short, actually. So that is to say, no, I said that wrong. You have the time decay problem if you're long in calls and if you're long in puts. And being long in a put is, of course, a short bet as a directional bet. You're betting on the market going down. So this MES contract might be the way you would want to experiment with making directional bets at a time like this. And that's generally true of futures. People, young people don't trade futures enough. They don't know enough about them. And yet they're far better to trade for standard directional bets for reasons I've already brought up, in my opinion. Now, we're talking, though, about hedges. Now, the reason, again, that index funds are great, this is, I think, the third time we said this, is because they stay flat going out. They can't really go into contango. They can't go into backwardation because of arbitrage possibilities, because their only carry cost is interest you would have to buy to be, say, short of the contract. And so if we take a look at today's index funds, this is an example of this. I actually chose real data to sort of show this. This was from on April 7th, 2020, around, it was after the stock market had closed, but this market was still open. And the SPX had closed at 2657.81. And you can see the June, September, and December contract for the micro E-mini contract, 2638, 2631, and 2609. And so I'm showing those as being represented more or less along or pretty close to the futures price lower limit line that is determined by the carry cost. And you can see that there's not much of a deviation between the price SPX spot and the December price. And so again, these markets will never show expected future prices for these indexes. They are not good proxies. They may be reasonably good directional proxies, and if they are, then this is showing that the attitude, at least at the moment I took this, was fairly bearish, because they are sort of bouncing along the bottom of the future price lower limit rather than, say, the top of the future price upper limit. But even directionally, I don't think that necessarily this is a very reliable indicator. The fact that they're flat, however, allows us to use them as a hedge, because the expectations about future inflation or whatever will not be baked into the contract to make the hedge too expensive, a problem we talked about pretty extensively in Econ 104, if you recall. Now, I'm going to introduce, we're going to be talking here in a moment about cross-hedging, and I'll explain that when we get to it. And what we use in a lot of the hedging formula is what is called the minimum variance hedge ratio. And this is kind of traditional material that I actually pulled out of Robert Hull's book back in the years when I used that book as a textbook. And so again, if you look at this is the ratio of the standard deviation of the delta or the natural log of spot prices in the numerator, the standard deviation of the delta or the natural log of the future price in the denominator for whatever contracts you're talking about, and the correlation coefficient between the two. Now, when you say, what do you mean standard deviation of delta or log? Well, all along we've been using log growth rates for these prices. And so, of course, when we're using the approach that we've been taking, if we were talking about stocks here, and we can certainly be talking about stock indexes here, as you can see in a moment, then we've been taking the natural log. We are not using the raw data because you can't do this with the raw data. The raw data, in fact, we're assuming to be more or less log normally distributed with a lot of error. And so we can't use, therefore, a non-log distribution in our assumptions. But more importantly, it's just you get spurious correlation if you use unadjusted data. It has been traditionally, though, the practice also to use the delta in the price instead of the natural log. In fact, a lot of the literature, including the literature that's in Hull's book, uses the delta, meaning the difference from one day to the next. Now, I don't use it because even that has a trend variable over time, because the delta actually grows up. The delta actually increases if the growth rate is constant, because the number itself gets bigger over time. But that hasn't been a problem for many people, and so a lot of the research that was done, especially a few decades ago, was with the delta rather than the natural log, or by some other measure of dispersion today. So we allow that because you'll see it in the literature. So you say, well, this looks suspiciously like the beta. Well, this is the beta, except that we're just using different classifications of prices. This sort of beta construction where you take into account the two levels of volatility and the correlation is everywhere in finance. In this context is called the minimum variance hedge ratio. The exact same formula when used in reference to index funds, as we're about to see, is simply the beta. Now that we've seen it and now that we know that it has more than one application, let's talk about that. This turns out to be very easy. Again, this is traditional hedging theory that you find in a book like Robert Hull. So suppose for whatever reason you want to hedge a stock portfolio with the S&P 500 futures index. Well, if what you want to hedge is SPY, or the Vanguard S&P 500 index fund, really easy to hedge. You just figure out the nominal value of your portfolio, the nominal value of a single contract of SPX or one of its two derivatives, the micro or the mini, and you divide one into the other. But what if you want to hedge a different kind of portfolio that is not SPX or is not the S&P 500, just a portfolio of stocks of some kind? Maybe they include some of the elements of the S&P 500, but there's some in there that maybe aren't in the S&P 500. Well, to do that, according to the theory, you have to calculate the beta of the portfolio relative to the S&P 500. So basically, it's this index we just looked at, except that the numerator is the standard deviation of the portfolio. It's the portfolio you're trying to hedge. The denominator is the standard deviation of SPX, or the SPX futures contract in this case, and the correlation coefficient is the correlation coefficient of those two. So of course you have to use historical data to do this, and or if you can use actually fairly close term historical data if it's granular, because you don't have to use daily data. You can use tick by tick data or second by second data or minute by minute data if you want to do this. It depends on the context as to how you do that, just like everything else we do. So if you want to hedge a stock portfolio, then you make the adjustment that's described here. You take the value of the portfolio and you divide it into the size of an S&P 500 futures contract, one of those three, SPX or ES or MES. Let's just say it's ES. and then you multiply that times the beta, and that is going to give you the number of S&P 500 contracts that you buy. And that is supposed to minimize your cost while at the same time sort of maximizing, in a sense, the response of the portfolio to the S&P 500, or the other way around. So this is the standard formula that is used for that. Now, there's when we talk about the relationship between the SPX and, let's say, S&P 500 Vanguard, or a portfolio of large cap stocks that's somewhat correlated with the S&P 500, these stories kind of turn out to be kind of interesting, because ideally when we talk about this kind of theory, we're imagining in all of these discussions about why everything stays within its limits and so forth, that these markets are open at the same time and they're continuous markets, when in fact they're not. Interesting problems arise from the fact that the futures market is actually open and liquid for a lot more time than the stock market is in the United States. Of course, in the United States, the stock market opens at 9:30 New York time and closes at 4. Well, the futures market, as you know, during that same 24-hour period is shut down only for whatever we said, about an hour to an hour and a half on that same day. And then, of course, on the weekend, the futures market is open a lot longer on Friday night, and it opens fairly early on Sunday evening. And so what this results in is kind of interesting, is sometimes these discontinuities between these markets have some interesting effects. Now, this is something I'm asking you to imagine, going back in time where maybe we might have seen this. Take a look at that green line, and that's supposed to be when the stock market and the futures market is open, and let's say that that's the SPX, and they're moving perfectly together in tandem. Or they're not going to be very far apart. I could have shown the futures being a little far apart because you do have a little range in your upper and lower limit. But let's assume that they're sitting right on top of each other for some reason. And then we get to the market close. And the stock market closes, but the futures market keeps going. Now, I see this every day, of course, because I have the big machine upstairs running, and I've got this little machine here, a little demon running all the time too, although I don't monitor it. It's picking up the implied volatility measures for our class in SPX mostly. So we're looking at it, and I see what happens when the futures market keeps going after the stock market stops. But so we're representing that sort of metaphorically here with this black line. That's the actual market close in New York. But the futures market keeps going, and let's suppose it really goes down a lot. And the dotted line represents the close of that day. And so when you look at the charts, they often have this kind of configuration. So the question becomes one of what's going to happen when that market opens back up at 9:30 in the morning on Monday, if this was a weekend, for example, or just the next day if it's not. How are these two brought together if you have a close and you have the S&P 500 futures contract way down below it? Well, normally it is taken care of. That we're asking, how does that gap close? You'll notice down there a little date popped up, October 13. I wonder what year I'm referring to there. Well, so the mechanism does close the gap. I see it happen because I'm always up at 6:30 and the market's running. I usually have it up and running by 4:30 or 5 o'clock in the morning. And program trading, actually, the old-fashioned program trading, is supposed to bring these back into alignment. And there is a very complicated morning auction process at all of the exchanges that sets the morning open and gives them a few minutes to figure out, what the price is going to be. I've never tried to describe that morning open in Econ 136 because it's so complicated, but you can look up references to the morning open on the New York Stock Exchange and at NASDAQ if you want. It's supposed to bring it into alignment. But there are times when there was at least one time when it did not, and that was October 13th, 1987. What happened then was the program trading that was being done at that time had found this enormous gap between futures prices and what the last spot prices were, which is basically the stock market itself, or the S&P 500. Now, normally when I watch it adjust in the morning, it kind of comes together a little bit because it's a little bit apart every day, especially at times like this. That's why I've been watching it so much, because these markets are so volatile. So the futures will sort of like maybe be way down or way up, but let's just say way down, well below the close. And then you say, well, does that mean that the open on Monday morning or the open on Tuesday morning, for example, is going to be down there close to the close? Actually, you see them kind of come together. And then they finally line up kind of right at the open, and then they sort of part company again a little tiny bit throughout the day. But something happened given the scale of the futures market decline on October the 13th, 1987, where basically all of the orders were one-sided on the stock side. And the orders on the stock side were just saying sell, 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 sell. And as that happened, the futures market just kept going down, leading the stock market down with it. And nobody knows for sure exactly how this happened. But it looks like apparently that the computers did not have threshold markers on them to stop the trade. They were not yet using circuit breakers. Circuit breakers came because of this event for the largest part. That was the origin of circuit breakers after this. So everything just kept going down. And it was kind of like computer driven. These algorithms were chasing the spot algorithm was chasing the futures algorithm down the rabbit hole until the market had its spectacular 22% in one day drop. So it was kind of something like this that happened. And it's interesting to watch it today because it's kind of interesting to watch how jerky this stuff gets right just before 6:30, because these do have to come in to reconciliation by the opening market. And aside from a couple of weeks ago when they had to do a trading halt literally like 15 seconds into the market, I don't think it was the day where the Dow fell 3,000, or maybe it was that day, I forget, but I remember seeing it. There was a trading halt within seconds. They couldn't get this to work. And the trading halt that they had within seconds probably kept the market from going completely to hell, because it gave them 15 more minutes to try to get the trades matched. And you should be aware that stuff is going on in the background when you're looking at your little informationless Robinhood screen. Okay, back to hedging. So a lot of hedging is very simple, right? Here's an example that I've always used about copper. Copper has been one of these metals that has also come down a lot in value with this. The big contract is 25,000 pounds. There's an E-mini copper contract for 12,500. It's priced in dollars and cents per pound, like $2.35. It's priced into 4 decimals, actually. $2, and as you can see there, 3160. Current notional value is $57,900, and the maintenance margin is a little higher than usual because of the volatility in this market as well, at 3,750. Now, in the example that I give about suppose you manufacture copper rotor induction motors, popular because they use no rare earth elements, and you use 23,000 tons of copper per year. This, of course, would be a godsend for you if that were true. But you're in a competitive industry, and a large price increase would bankrupt you if not hedged. So in this case, it's fairly easy to hedge if you think you can cover the margin. That's the big deal. Of course, you can if you're a large company, you can borrow the money to cover the margin, so the real cost is the interest on the margin. But you would have to be long about 150 contracts per month in the futures chain if you're trying to hedge that. So examples of traditional straightaway hedging, where you've got a commodity that represents whatever it is you're trying to hedge. You're trying to hedge copper because you use the copper contract. Those are fairly common. Now, to again stress what is often said in Hull's book, is hedging always possible? Well, if the contract is in contango for whatever reason, it's not possible, especially if it's in a severe contango. It's not really the case right now that you could hedge against price inflation in oil because the contracts go up to $30 or so. And well, a week ago at least, the contracts were at $30 when spot was 20. So if you have a contract in contango where just price is rising considerably because you have high carry costs, then you really can't hedge. So if you need to hedge long and prices are at the top of their range, it's sometimes obvious you should have hedged a year ago. What good is it to hedge long in a crude oil contract if the current spot and futures are above 120? And you say, well, they're not above 120 ever. This example came from the 2009 contract when it actually was above 120. The price of spot oil was above $120 a barrel at that time. I was working for an energy company as a consultant or kind of a director as well in mostly natural gas. And that's when this stuff is insanely distorted, 2008, 2009, 2010. So the rule of thumb is probably the best time to hedge is when the current market makes it seem like you don't need to do it. That's the best time to hedge, when there's no inflationary pressures or price pressures that you can see, but you can hedge out for a year. You say, well, I like this price and the margins are pretty low and we can all have to do is borrow that, so let's hedge out. And so there's a quotation I've used from 2006 about jet fuel, about a guy that did it for air transport. The market price may be higher, it may be lower, but I know what I'm going to pay and I can set my business plan accordingly. So hedgers are corporations that use these raw materials. They're not in the business of playing the market, they're in the business of manufacturing. And if they can set their cost at a fixed value through a hedge, then in some cases they're going to be willing to do it. Now Hull points out though that it's not done as much as it should because of basic ignorance. This is straight out of Hull. We know, for example, if you take a long hedge to avoid the cost of rising prices and the price of the commodity declines, then you're going to have to deal with the cash requirement of settlement, which can be considerable with a large hedge like jet fuel, for example, that the airlines used to use and still maybe do. This presents an interim cash flow problem even though the hedge is locking you into a known price. So if you go into a hedge for reasons that we explain in the very first lecture of this set of 4, the hedge is locking you into a price indirectly because of its impact upon settlement. And if that's what you want in your business, you're doing the right thing by hedging. But like Hull says, not all executives understand the hedge all that well under these circumstances. Remember we said these futures contracts can get complicated. What's settlement again? How's it work? So as Hull points out, it's easy to see why treasurers are reluctant to hedge. Hedging reduces risk for the company. However, it may increase risk for the treasurer if others do not fully understand what is being done. And this is what Hull has always explained as the reason that businesses are frequently under-hedged, because nobody understands what the hedges are supposed to do, except the really smart people who know how to actually mitigate risk. Now, cross-hedging is an interesting topic. You may want to hedge, but there aren't that many contracts traded with futures, as you know. There's the core metals are like copper and aluminum and gold and the precious metals and the like. But suppose that in some iron contracts, suppose that you're an airline satisfied with the current spot price of Jet A1 jet fuel, or sometimes called JA1 jet fuel, which is used for commercial jets now, and there is no jet fuel contract. And suppose you want to hedge long this price in the future. Suppose you're Southwest Airlines, who does use hedging from time to time. There's no futures contract, but you know that jet fuel and RBOB gasoline, for example, are strongly correlated because they're both distillates. So maybe you can hedge a jet contract using an RBOB gasoline futures contract. But what if the volatility of spot jet A1 is much greater or lesser than RBOB gasoline? That's a class of gasoline that's understood by people who trade it, even if the mean rates of price change are about the same. So in other words, suppose you discover in your study, and this is studied a lot by the way, that the mean prices tend to move together, but one is way more volatile than the other around those means. So this is going to make our hedge imperfect. The example that if you're looking at whole, as we go along in this class, is example 3.3. So you do cross-hedging. So here's an example. So how many contracts would you purchase when you're trying to hedge this position? For example, suppose you want to hedge because you're buying 1 million gallons, 24,000 barrels of JA1 jet fuel in June. So what size long June contract should you buy, and also what contract should you buy? Well, the answer is going to be this, according to Hull. And the H there is the minimum variance hedge ratio, but it's the beta formula, except with the special application that we gave you in that formula about 4 or 5 slides ago. It's the beta of the ratio of the spot of the commodity that you're buying to the futures contracts of what you're going to hedge it with. And so you take the size of the position that you need to hedge, divide it by the size of one contract for the hedging instrument you're going to use. And so this would be the size of the position in jet fuel, for example, divided by the RBOB contract specification if you're using RBOB gasoline. And that gives you the value that you would use for the number of contracts. Now, this is an older survey, but to show you that actually people take this serious, these researchers here were trying to figure out the correlations between jet fuel, crude oil, heating oil, using 2 years of historical data. And you can go take a look at the original slide, which will now be posted now that we've completed all 4 of these, and take a look at what they concluded based upon this when you take a look at this graph. But basically, they're trying to figure out exactly what the minimum variance hedge ratio should be for a contract like this. In the class in the past, we can't do it this year because we don't have time. We have ourselves made these calculations because it's actually pretty easy to do. You could do it in Excel. You don't have to do it in Python. And so we discovered the last time we did this, which was not last year, I don't think, it was 2018, that the correlation coefficients of the jet fuel and SD gasoline was 0.62, and the beta was only 0.41, and that was using daily data. We took a look at jet fuel and RBOB gas, and we found the beta higher, and we found that jet fuel and West Texas Intermediate crude actually had the highest correlation and the highest beta. And so you would hedge with the West Texas Intermediate crude contract after you conducted this kind of study if you were trying to hedge jet fuel. So down there on the bottom, if you understand this, then we take a look at some of the distillates. We took a look at one of the original sources, WTI crude itself, and it turns out that crude has a better correlation. So when you do this, of course, you have to make decisions about the data and so forth. So in this case, we use daily data and weekly data, actually in a couple of cases going back more years, and did what we could do, of course, with free data. And nonetheless, you could kind of figure out how this is done. So this year we can't do it because there's no way we can do it doing all of this stuff remotely. So here's a few things that I want you to take away. There's not much from the hedging lecture. Index futures, again, can't go into contango. This is probably the 4th time we've said it, so you should really understand that by now, which makes them ideal for hedges because they're not going to be in contango or backwardation when you want to hedge. If hedging any non-SPX portfolio with SPX, then you calculate the minimum variance hedge ratio, which is beta. And you should know the formula for beta. We learned it clear back in Econ 104. It's used everywhere, of course. Third, cross-hedging is used when you have to hedge one commodity or instrument with another that is merely correlated. And the coefficient of adjustment is, once again, the beta or the minimum variance hedge ratio. And we got that example from jet fuel and West Texas Intermediate crude. And then finally, by now you should understand the basis of the spread strategy that we're playing. Remember, the penny calculation or the dollar calculation is now dependent upon not the directional price of crude oil, but upon the narrowing of the spread is positive for our settlement on net, and the widening of the spread is negative for our settlement on net. And the penny calculation is the same as it would be for any directional bet. So I think that will allow us to conclude this and get back on to the material we have to get back to for the more advanced options models and the like. And so you'll be hearing from me pretty shortly now that this is up. The full-length slide set that supports all four of these will be posted sometime today or tomorrow, probably tonight at some time. And then I'll be talking to you about the quiz we'll have for this futures material. Now remember, with respect to the quiz, that's going to be based upon the ending slides where I say you should have these takeaways, right? The examination, which will be a little quiz online, will be dependent upon the clues that are in those takeaway the takeaway ending slides, I should say. Okay, so we can stop this now and move on to more advanced modeling.